Okay, now, again, I've just updated these slides. 6 months ago, it would have been a very easy argument to make here. But you can see this recession has been much sharper than the last recession. We've zeroed it all out and plotted it against the last one back in the 80s. And what we have seen here is capital growth in the house industry of 6%. Now, what I've said here is the third item down there, indices, and underneath it may be nearing the bottom of the market. I actually don't believe we are at the bottom of the market and are coming out of recession in terms of house prices. This is an indices-led graph, and indices report what is going on at the moment. All we're seeing at the moment are the people who can actually transact at the moment are those who can get mortgages. They're the ones with high levels of equity. This doesn't represent the first-time buyers. It doesn't represent those terrace houses in Bolton, North Lancashire, the mining towns of Yorkshire. It doesn't. Those houses, I don't think, are going up in value. And then we looked at it. We looked at that rise a little bit more closely, and what we found is actually, I guess my gut reaction was, oh, that's growth that's been delivered by London and the South East. Not at all. Strangely, East Anglia, Yorkshire and Humberside is the growth that's the greatest contributors to that 6% growth in the UK market. And they are just growing, and East Anglia is the one that's going back beyond where it fell to. London is still behind. So that's a market with still opportunities in it. And I'll show you another slide later on showing about the volatility of those sub-regions. The final point there was affordability. Now, this is a slide which came out 2 weeks ago. I don't know if you only get research from Capital Economics, the most dour set of people I know. They get a good news, and they can spin it into bad news. Incidentally, when they were forecasting a crash of house prices by 30%, we haven't reached that point yet where it should be crashing by another 30%. But what the Council of Mortgage Lenders came out and said, we are at the level of affordability now has never been better than in the last 35 years, which is a great thing. Great for if I'm trying to sell residential. Capital Economics came out and said, oh, no, it's not as good. And to be fair, their measure of affordability is far more robust and is a safer measure. So they came back and said, oh, it's nowhere near as bad. It is just below its long-term average. Well, I think that's a good thing anyway. And again, it makes it an easier sell. If it was well over, that would be hard. I wouldn't be persuading you to invest in residential. So that's a good position that we're in at the moment. Okay, that's the residential, the attributes and why we like it. The second part, if I've persuaded you or you're moderately interested and you should think you should be investing in, and you're not long in residential and you should be investing in it, what's the most appropriate method? We believe that the collective investment vehicle. I'm just going to read this. Would you, I'm under time now, would you concentrate your wealth in a single investment, gear it up to the hilt, creating volatility in it, putting risk in, be happy with those volatile returns? You don't do you don't do professional management. You're reliant on a single tenant where you've got no recourse if they move off. You can't buy it at a discount. You can't buy deals that offer different attributes. You wouldn't be able to get into a ground rent portfolio, for example. For me, the most important one, would you risk a criminal offence? If you haven't got a gas safety certificate, it's a criminal offence. If you don't have a risk assessment, health and safety assessment, it's a criminal offence. There are loads of these regulations which if you as a single landlord, these will come bearing down on you. And it's no joke. We actually did have a house in North Wales where we were phoned up, and the tenant, we don't know what he was doing, but he'd blown up his house and he was found on his front lawn at 2 o'clock in the morning. Unfortunately, he did die later, and my first reaction, did we have a gas safety certificate in place? Fortunately, we did. We've got very good managing agents. So yes, do you want to be on the right-hand side, professionally managing your asset class? So I pose the question that what kind of vehicle do you think would be right? Would it be a closed end? Would it be an open-ended, a large, massive floating vehicle? I'm not going to say what type of vehicle, Guernsey offshore, to get the tax benefits. I'm not going to dictate to you what that is, but I believe that residential is not an asset class for individual or small-scale investment. It should be pooled to diversify that risk away. The other benefits of a pooled vehicle are you can invest in a SIP, you can invest in this ISA, you can drip feed investment into it, single payments, you know it's going to be good in the long term. So it benefits that pooled investment vehicle. How long have I got? 2 minutes. Moving on. This next slide, Tim. This next slide. Now, as a fund manager, if I was putting a fund together and I was saying, right, we like house price inflation, HPI, I'm up against it because immediately I buy something, I've got traction, I've got friction costs, I've got a cost of acquisition. Secondly, I've got the exit costs as well, so I'm behind anyway. Plus, I'm buying at my portfolio is valued at a market value which is lower than the vacant possession value, which is the house price indices. So what's in my armory as a fund manager? This is a classic example of the different regions. And so here we have Scotland, -8, Southeast England, nearly +4. That's nearly 12% range just by buying in the right region, moving, fine-tuning your portfolio to get exiting one and going into a different area. The other interesting area which comes out of this slide is London. What a low volatility market this is. Over the 10 and 5 years, the volatility is very low. And so if you want to, we know the asset class has low volatility. If you want to lessen it even further, you can actually specifically target regions to actually be investing in. Plus, with the advantage we have research-based forecasting and professional management. Also, we'll be buying in bulk and buying portfolio, and we'll be able to buy a diversity of the asset classes. Investment, but it does come with a health warning, and I told you about one of the other investments we have equity investment in. What we did here is, this is a portfolio bought in the early 2000s. There was massive house price inflation at those stages, so we were expecting to see fantastic returns on our initial cash investment. And they weren't there, so I managed to get all the valuation reports and we drilled into it. So we zeroed the benchmark, which are the nationwide house price indices, to 0. So anything above the line is outperforming, and anything below the line is underperforming. And that is underperforming on a per annum basis. We would have been better off buying a single house in Kensington, leaving it empty, or in fact, putting squatters in it, and we would have done better than the fund manager, easily. So that would be a health warning of how not to do it. Just to wrap up very quickly, I'm just going to give you a few examples of what we like and what we don't like. And that is available. These are actually live deals. Well, they've gone now. But for example, ground rent portfolio, in the current market, a lot of developers used to hang on to they'd flog off the flats, hang on to ground rent, and it was quite a nice investment for them. Now times are hard. We're seeing a lot of these coming to the market because it's an easy deal, an easy trade. To the right, basically period conversion. These have been one of our best performing assets in the portfolio. Great to have. Again, unlike commercial, the older residential gets, the more valuable it becomes. Next. A little one here, a small little development site. We don't like large developments because we've got affordable housing elements to put into it. Small enough to not have that, and we can cope with that with our in-house. We're not developers. Again, scheme on the right, 38 flats. Again, you're buying the freehold. You're not buying individual flats, so you're not subject to a service charge or ground rent, which eats into your returns. We are in control of our own destiny, and you're not flooding a particular rental market. So that's a good buy. Again, this is an example of what we don't like. This is the buy-to-let portfolio. Individual flats dotted around, subject to ground rents and service charges. That we wouldn't be interested in, not our bag. You don't have the control. So when the landlord decides to put a new roof on, that's going to come out of on your bottom line. So finally, residential has strong fundamentals historically, and it's got good structural potential going forward. We believe it is the right, it's not the best class and not the best way to invest it in individually. It suits a pooled and grouped investment vehicle ideally, just for the scale of things. We're looking at avenues and ways to increase that market, but I say it's a yawning gap in the market that there aren't those pooled investment vehicles or open-ended funds available to the investor. Thank you very much.